I had a question posed to me quite recently, and to be fair, I've had this question posed to me a good few times in the past. So I thought I'd, shoot this video and outline the overarching considerations. And the question is around, so we had a father who owned a property in his name, and he was asking that, can I, as in his main residence, so it was valued at around £600,000, can I transfer this property to my son's name, but continue living there? So I continue to live in the property, but I transfer it to my son's name. And, generally speaking, the discussion was around inheritance tax planning. So in terms of, whether you can do that or not, you can do whatever you like, right? Sometimes I have clients, they ask me certain questions. Can I do this? Can I do that? You can do whatever you want. That's the starting point. And then it's about, okay, so for inheritance tax purposes, there are specific rules that need to be considered. Before we go on, don't forget to like, comment, share and subscribe to my channel. My name is Omar Aswat. I am a chartered tax advisor, owner of Aswat Tax, a specialist UK and international tax advisory firm. So feel free to reach out if there are, if there are any pressing tax issues. Feel free to reach out. So we have the father transferring or wanting to transfer the property, the main home, to the son, but continue to live there. And the issue with this is that if you transfer the property, and I'm talking from an inheritance tax perspective specifically, so we have there is capital gains tax to look at, but in this particular case, it would have been covered by the principal private residence relief, so PPR relief, and therefore capital gains tax weren't relevant. Stamp duty, land tax, again, weren't relevant. Why? Because no consideration and no mortgage outstanding. That's a key element. I'm giving you guys free pointers and tips and advice here. But from an inheritance tax perspective, so the issue is that if you gift the property, but you continue to live in it, there are specific anti-avoidance provisions that come into play, known as the gift with reservation of benefit rules. Okay, gift with reservation of benefit anti-avoidance provisions. Okay, found in the Inheritance Tax Act. So effectively, what we're trying to say, or what is an anti-avoidance provision. So what the measure is trying to counteract is that you gift away assets, but you're still gaining a benefit. So another example would be, you gift shares, but you're still receiving the dividends. In this particular case, you're gifting the main home, but you're continuing to live there. And therefore, you'd have the gift with reservation of benefit provisions kick in, meaning that that asset would still be, so the £600,000 in this particular case, would still be in the father's estate on death, unless, okay, a big unless, capital letters, which is that if the father pays market value rent, okay, what is market value rent? That's what the next question would be generally from clients. That's a different discussion. But if the father pays the son market value rent, so you gift the property, you transfer the property into the son's name, land registry, TR1 and the rest of it, and the father continues to stay in the property and pays the son market value rent, then it is outside the estate for inheritance tax purposes. Now just keep in mind, this is two key points to keep in mind, very important, very specific and intrinsic points that most would miss out on or wouldn't really consider. So the first is that now the son has to pay personal income tax on the rental income received from the father, which needs to be declared on the son's tax return. That's the first point. And the second point, which is very specific, is that one may have come across the 7-year rule, okay? So one may say, okay, I gift the property today, 14th of September 2024. I pay market value rent up until 14th of September 2031, and the asset is outside of my estate. No. Okay, for the gift with reservation of benefit rules, you are looking at 7 years before death. Okay, so you're looking at 7 years prior to death. So effectively, what I'm trying to say is that the father must continue to pay the son market value rent up until the date of death. So there's no sort of going around. There are other ways to mitigate UK inheritance tax. There are many strategies, structures, and solutions that we can implement. We can explore. The first step is to have that initial discussion and explore what we can and can't do, and then from there it's about us utilizing our expertise and advising you and implementing certain structures. But yeah, I hope you found that beneficial. Very interesting point. Definitely interesting for me. I know you're going to, you're probably thinking this guy's a bit of a tax geek. And to be fair, I am. In terms of, you can see a similar example in HMRC's Inheritance Tax Manual at IHTM 14335. So this was extracted when I was looking into the matter, or when I've previously looked into the matter. As I say, don't forget to reach out, and don't forget to comment with your thoughts. If you have any questions that you want me to pick up on, happy to spend some time for you. But yeah, reach out if you'd like a chat. Speak to you soon. Bye.